Bring that ass back like a boom, 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 boom.
Hey folks, welcome to Boom Traders weekly overview for January the 30th. We have the last week for January and going into February. Now our session overview will follow this structure. We have the risk vest or the general market situation, our tactical trading environment where we review different setups and how they're working. We have some relevant data for you and a summary of the market conditions. So let's start with the risk vest, and we have it on sell signal since the 22nd of November last year when markets started turning, but what was more evident was the market conditions underneath. So our risk vest model is comprised of 4 different elements. We have the general market, which is on negative. We have the up and down volume, which is also negative. We have the new highs and new lows, which are on negative as well, meaning that more stocks are making new 52-week lows. And of course we have the stock participation on negative, which is basically the advanced decline lines, which you will see in a bit later. Now our tactical trading environment, or the setups that we are trading, is on red. Basically breakouts, because we are mainly doing breakouts, are not working. Bases are not holding, or if there is a breakout, it tends to fail rather quickly, so there's no follow through. So we have our general market on sell signal, and we have our tactical trading environment on red, which means that maximum caution is advised. Now when we do our trading tactical environment check, the checklist that we go through are the setups, and as I said, mostly breakouts. We have confirmations or violations of those setups, where's the failures happening, whether there's the base or at the pivot point, how many times we've hit our stops, and are there stocks that are extended. This is the place, and as we said, the 22nd of November, as you can see right here, this is the date, 22nd of November, where the sell signal was issued. This is on the Nasdaq, and as you can see from there, which is about 16,000 level, we dropped to 13,600. Now you can also see that on the IWM, this is the small caps, this is where the sell signal was issued. We had a pretty substantial drop from 2,300, 230 to 190. Now there's one thing that I want to point out, and that you must be aware when trading in this environment. Seasonally, for the last 72 years, this is the S&P 500, January, February and March to some extent has been the weak periods. Now if we flip this for the last 10 years, you will see that January, February and March are the 3 weakest periods of the year, especially March, but this sharp drop is due to the 2020 COVID correction. So these 3 months are something to be aware of, and really have some picky nature in terms of what you're trading. Now another so to speak evidence that we are extended in this sort of correction that we're having right now is past due, is the normalized returns of bulls and bears for the last 60-70 years. As you can see, with the exception of 1990 to 2000 rally, the one that we had before the COVID crash has been the biggest ever in history. As I said, only eclipsed by the 1990 to 2000 rally. So some corrections are due. And in terms of all-time highs, the S&P 500 made 17 new all-time highs in 2021. And as you see how they spread throughout the year. So there's really nothing surprising that we're having some sort of a correction here. Now this is the VIX signal. When the VIX signal is above 30, the environment for trading becomes extremely difficult because volatility is increased, which makes for a lot of risk. And as you probably already know, risks to reward is the biggest edge that you can have. So when volatility increases, you have to increase your stop loss, which makes it impossible to trade in terms of small risk and large reward. Now we had VIX going over 30 last week, then it dropped, and it's up to see what will happen this week. Again, we can talk about the markets all day long, but the problem is the stock. And stocks that have been going really well for 2020 and 2021 are dropping immensely. Let's start with Peloton. And Peloton is the home fitness company that was delivering a lot of fitness equipment during the COVID pandemic in 2020. It rallied all the way up to 170. And as you can see, from the beginning of 2021 to 2022, Peloton has lost 87.7% of its value. Robinhood, this is the online stockbroker, from August to the end of this year, it lost 76%. It went from 86 almost to 1273. We also have Netflix from 700 to 384 due to earnings, but what is more important, growth has slowed down, which also made Netflix increase prices in the United States and some other regions of the world. Not really likable for the investors. Now we have Amazon that dropped 1,000 points, and as you can see with Netflix and with Amazon, this has happened from late November till January. So we have 3 months and they're losing quite a substantial chunk of their value. Last but not least, ARK investment funds. As you can see, Cathy Wood's investment fund has dropped from 160 to 60. And as we've pointed out here, be very careful with bottom fishing. Bottom fishing is not for everyone. And it's really hard because you never know how low it can go. Now let's talk about some charts in the general market. This is the Nasdaq. And what we have right here, let me just get my pen to make it a little bit more visible. So what we have right here is the percentage of stocks above the 200 moving average and the percentage of stocks above the 50 period moving average. As you can see, we have 15.98 or 16% of stocks in the Nasdaq are above their respective 200-day moving average, and only 12% of the stocks are above their 50-day moving average. And that's a problem, of course, because we don't trade stocks that are below their 50-day moving average in terms of breakouts. Here is some representation of the sectors, and again, the stocks above their respective 50-day moving average in those sectors. As you can see, a couple of trends that have been developing for the last couple of weeks. Money has been moving out of growth and into value, and the clear winner of this for right now is the energy sector. You see 95% of the stocks in the energy sector are above their respective 50-day moving average. The other one is the utilities, XLU, and consumer staples has been strong as of lately last week. Now in terms of the 200-day moving average, we have 100% in the energy sector, 85% in the utilities, and we also have consumer staples and real estate above that line of 70. Now let me talk about the charts of the indices for just a short period of time. This is the Nasdaq. I'm not going to go that much on the chart, but you already know we saw some consolidation down here in this area, which is support, and you can see clearly that we are on the brink of a breakdown. This is the support line right here. Sorry for for my drawing, not the best that you can get, but this is a support line for quite some time. So if we break that, we are probably gonna see some lower lows. But what I really want to point out is the advanced and decline line. So basically what the advanced decline line is, it's a combination of all the stocks that are declining and all the stocks that are moving up. And as you can see, as I've pointed out, the advanced decline line right now for the NASDAQ is at a point, these points are equal in value, is at a point where the NASDAQ index, the QQQ, was about 150, 160 in value. So basically that shows us that there is still a lot of weakness in NASDAQ composite index, and we might see some further down. This is the S&P 500, and again we are at support, but I will switch the charts to the advanced decline line of the S&P 500, and you will see that this one looks much better in terms of composition and in terms of where the advanced decline line is telling us the price should be. We have a price about 380, 390, and we are at 441. So yes, there is the possibility of a further drop, but it's not quite substantial. I'll go to IWM. This is the small caps that broke their more than 1 year base and are now trading below. But in terms of the advanced decline line, it's basically in sync with what is happening in the market. So I'm not as worried about the IWM as I'm worried about the NASDAQ. Last but not least, the Dow Jones Industrial, and as you can see from the chart right here, it's acting much better than the other indexes. But what is really important to note, and I've had some lines drawn there, we are seeing a divergence in terms of price and advanced decline line. So what we have here are two lows that are lower lows, but the advanced decline line is making higher lows. That means that less stocks are participating in this drop, and most probably the other indices are dragging Dow Jones Industrial downwards. And as I've mentioned, money are going into value stocks, not so much into growth stocks. So Dow Jones is the clear winner of this situation, and if you're looking for something to trade, please look at the value stocks. This is the 10-year treasury note from the United States federal government, and it's approaching the 2.0 level, which many analysts are indicating as a critical level, and the goal is to remain below it. So we're just taking a look at it, take a note, and follow this. Usually, if the market goes up, the treasury notes are going down, vice versa. Last but not least, this is a chart of the highs and lows that the stocks are making. So this is a 52-week high against the 52-week low for all United States listed stocks. And as you can see, from late November when we issued the sell signal, this is crossed, and the red line indicates that more stocks are making 52-week lows than the green line, which indicates the 52-week highs. Now, just to give you a sense of where money are moving, I already mentioned value stocks. We already mentioned energy, utility, real estate, maybe for sectors. But if we make a more detailed comparison, you can see energy. Some banks, financials are doing good. Some retail, but you're probably wondering, what about technology? So these are the leaders. You can see oil and gas exploration, oil and gas field services, oil and gas refining and marketing, oil and gas integrated. In terms of banks, banks Northeast, banks Midwest, banks West and Southwest. Some food and beverages, some building and construction and agriculture. And in terms of agriculture, CF is a ticker that we're watching closely. But in terms of software, you can see them at the bottom. This is the bottom. This is where money are going off from. So we have software, consumer apparel, computer, finance to some extent, but as I said, banks are doing relatively okay, so this is an underperformance for sure. We have again software, electronics. So in most cases, this is representative of the Nasdaq drop. Last but not least, we have the percentage of bull analysts, and we are down to about 23% bullishness on those analysts. And as you can see, the previous drops, let me just get again my pen so I can show you a little bit. Now, as you can see in this drop, we had the bullish analysts dropping to 20.9. In this one, we had them around here. There was a very minor correction right here. We had those three drops. Right here, we didn't see anything, although this little bottom can be represented by those. The previous correction that we had was down to 22.45, and now we had 21. So usually that indicates a bottom. Now we are not saying this is the bottom. We're just looking at the facts and interpreting it for you so you can make educated decisions about your trading. But this is how it looks like. The put-call ratio is above 1. Well, it was above 1 a couple of days ago, and we're looking for ahead of 115, where it will indicate historically that we are hitting a bottom. We're still not there yet, but we're getting close to it. Let's look at some world issues that have been grabbing the media attention for the last couple of weeks. And top one, Ukraine and Russia tensions along the border. Now, this will definitely affect the entire market if either one of those countries decide to attack the other one, but mainly futures in terms of gas and oil. And as you can see, gas and oil prices are soaring. But also S&P 500 and the general market are not taking any war-related news well. And as you can see here in our statistics, on average the S&P 500 is down about 5% during these type of shock events, as we call them. However, there is one positive, if we can draw any positives from that usually market finds a bottom relatively shortly after such a conflict, with the exception of Pearl Harbor and Iraq and Kuwait invasion. As you can see, and as I talked about, volatility will increase in the event, in the case of such a shock event, and risk will be higher than the returns. So stay patient and stay mostly in cash. Now to recap, we have our risk vest on sell signal since November 22nd of last year. The setups basically non-existent. Market is in distribution, momentum is to the downside, volatility is high as indicated by the VIX, and there's no signs of a reliable bottom. Again, there is some sort of a bottom, but this is not reliable. So cash is king. Remember, cash is a position. Thanks for watching, guys. I really hope that you enjoyed the information, and if you find this valuable and you want to be part of a growing community of enthusiast traders like ourselves, please join us on our newly created Discord server. We're also on Twitter and on YouTube. So thanks again for watching. Please follow us, subscribe, and see you soon, hopefully in our Discord channels. Thank you and bye bye.